the Complete Beginner's Guide to Investing in 2026. If you've never bought a single stock in your life, this video is going to change that by the time it ends. But before I show you how, let me tell you the one mistake that's costing new investors thousands of dollars right now, and I guarantee you're making it. Stick around, because mistake number 3 is the one almost nobody talks about. Here's something wild. Just 10 years ago, only 6% of 25-year-olds had an investment account. Today, it's 37%. Investing isn't some rich person hobby anymore. It's basically become routine, like having a phone. But here's the problem. More people are jumping in than ever before, and most of them have no idea what they're actually doing. They're throwing money at random stocks they saw on social media and hoping for the best. That's not investing. That's gambling with extra steps. So today I'm going to walk you through the actual foundation, step by step, the way it should have been taught to you in school. Before you buy a single stock, you need to know where to put your money, because the account you choose can legally save you thousands in taxes. There are 3 main ones to know. First, a 401k. This is through your employer, and in 2026, you can put away up to $24,500 a year. Here's the part most beginners miss. If your company offers a match, that's free money. If they match 50 cents on every dollar, up to 6% of your pay, and you're not contributing at least that much, you are literally leaving money on the table every single paycheck. Second is the IRA, Individual Retirement Account. In 2026, you can put in up to $7,500 a year if you're under 50. There are 2 flavors, traditional. For most beginners in their 20s and 30s, Roth tends to win, and I'll explain exactly why in a second. Third is a regular brokerage account. No special tax perks, but no limits either. Use this once your retirement accounts are funded. But here's the curiosity gap. Which one should you prioritize first? It's not as obvious as you'd think, and getting the order wrong could cost you years of growth. Let's break it down. Here's the simple priority list financial advisors actually use. 1. Contribute enough to your 401k to get the full employer match. Don't skip this, ever. 2. Max out a Roth IRA if you qualify. Why Roth? Because you're probably in the lowest tax bracket of your career right now, paying taxes today at a low rate, then never paying taxes again as your money potentially multiplies over 30 or 40 years. That's one of the most powerful moves a beginner can make. 3. Go back and max out your 401k if you have money left over. 4. Anything beyond that goes into a regular brokerage account. Simple, right? But here's where almost everyone gets stuck. They don't know what to actually buy once the money's in the account. That's coming up next. This is the part everyone overcomplicates. You do not need to pick individual stocks. In fact, trying to pick winning stocks as a beginner is one of the fastest ways to lose money. What most beginners should actually buy is something called an index fund, specifically something like an S&P 500 fund. Here's what that actually means in plain English. Instead of betting on one company, you're buying a tiny slice of the 500 biggest companies in America all at once. Apple, Microsoft, Amazon, all of them in one purchase. If one company crashes, you're not wiped out, because you own hundreds of others too. This is the boring strategy. It's not flashy, it won't make a viral TikTok, but it's the strategy that has quietly made more ordinary people wealthy than any hot stock tip ever has. Okay, remember that mistake I promised you at the start? Here it is. Panic selling during a downturn. Everyone expects the market to go up every single day. It doesn't. Some years it drops 10, 20, even 30%. New investors see that red number, panic, and sell, locking in a real loss on what was only a temporary dip. The investors who actually build wealth are the ones who keep buying through the dips, not the ones who run from them. Volatility isn't the enemy. Your emotions are. If this helped you understand investing for the first time, hit subscribe, because next week I'm breaking down the exact mistake that costs beginners the most money on taxes. And trust me, you don't want to miss it.